Don't worry, we'll let them bring out the CBDCs, the central bank digital currencies, and what do they say? We can have our finger on that button 24/7. You are going to be so off balance with anything they're doing unless you have food, water, energy, security, barter ability, wealth preservation, community, and shelter. You need to get those things locked in. In this year, I expect much higher spot gold prices. And no matter what happens with spot gold, because remember, a rising gold price is an indication of a failing currency. And so it benefits central bankers and those that are in power to suppress that spot price. But in the physical only, this is physical only market, we have seen at the upper echelons making way new highs. And even in the area that I personally buy into, still making this trend new highs. Get your positions built while you still have the opportunity. Do you answer this question for yourself. Do you want the central banks to have the ability to just at will? I don't. I want to be able to say to them, too bad, so sad. What you do, it's going to impact everybody. I'm not going to be immune, but I'm going to be more immune because I have especially the only financial asset that is completely outside of the system and runs no counterparty risk, none. But think all of this volatility and potentially those massive, higher than they can expect interest rate spikes. Will that force that Fed pivot that the markets are demanding? Who do you think is stronger, central banks or Wall Street? Guess we're going to find out, aren't we? And all of this. That's why gold is breaking out. And I'm talking about spot. I'm not talking about the real thing. That broke out a while ago. So let's look at this spot market because remember, we've talked about these different toppings, right? 1, 2, 3, 3 tops. A fourth is three is a lot, right? Where it goes up, it hits its head, and then it comes back down, goes up, hits its head. So that's what they're attempting right now, is to further push it down. The way that it works is really simple. When you have a spring, and that spring is held down, so the spot price on gold is held down. When that's released, it shoots in a direction. And that's what it's been doing. And I would consider this, now this I would not say is a pervasive breakout yet, but I would say that is imminent. So this is probably your best and least expensive time to position into this. Therefore, in this year, I expect much higher spot gold prices. And no matter what happens with spot gold, because remember, a rising gold price is an indication of a failing currency. And so it benefits central bankers and those that are in power to suppress that spot price. But in the physical only, this is physical only market, we have seen at the upper echelons making way new highs. And even in the area that I personally buy into, still making this trend new highs. Get your positions built while you still have the opportunity.
Lynette Zang continues to elaborate on the critical importance of physical gold as a hedge against the looming financial uncertainties posed by central bank policies and the advent of CBDCs. She underscores that the rising gold prices in the physical market, despite attempts to suppress them, are a clear indicator of underlying currency instability. This phenomenon highlights the necessity for individuals to act quickly to secure their wealth. Zhang points out that central banks have a vested interest in keeping gold prices low to mask the true state of the currency. A rising gold price is a public indicator of a failing currency, and by suppressing gold prices, central banks aim to maintain public confidence in fiat currencies. However, the physical gold market tells a different story, with prices consistently reaching new highs. This divergence between the spot market and the physical market underscores the importance of holding tangible assets. The necessity of building a position in gold is further reinforced by the ongoing market volatility and the potential for interest rate spikes. Zhang argues that the Federal Reserve and other central banks are not genuinely committed to controlling inflation. Instead, their primary focus is on maintaining economic growth, even at the expense of higher inflation. This policy approach inevitably leads to market instability, making gold an essential asset for wealth preservation. Zhang discusses the psychological impact of market fluctuations on investors, noting that recent sell-offs in gold may have discouraged new investors who entered the market during the upswing. These investors, having experienced losses, may be reluctant to re-enter the market, waiting for more significant dips that may never come. This behavior benefits long-term investors who remain committed to their positions, as they are better positioned to capitalize on future rallies. She also addresses the potential for further market volatility in the coming weeks, particularly in response to the Federal Open Market Committee, FOMC meetings, and other central bank actions. While the Fed may not cut rates immediately, their statements and actions will be closely watched by the market. Zang advises investors to pay attention to the Fed's actions rather than their rhetoric, as this will provide a clearer indication of future monetary trends. Moreover, Zang highlights the importance of understanding the broader economic context and not being swayed by short-term market movements. The current economic environment, characterized by high debt levels, ongoing monetary easing, and geopolitical tensions, creates a favorable backdrop for gold. These factors make precious metals an attractive investment for those looking to preserve wealth and hedge against economic uncertainty. Zang also touches on the critical need for community and local networks in times of economic instability. Having a supportive and resourceful community can provide additional security and stability, enabling individuals to better navigate financial crises. This communal support is essential, especially in scenarios where traditional financial systems may fail or become unreliable. In conclusion, Lynette Zang provides a thorough analysis of the current economic landscape, emphasizing the inconsistencies in central bank policies and their implications for the gold market. She underscores the importance of maintaining a long-term perspective and focusing on fundamental factors when investing in gold. Zang's insights suggest that, despite short-term market fluctuations, the long-term outlook for gold remains bullish. Investors should be prepared for potential volatility, but stay focused on the underlying economic trends that drive the value of these assets.
Are you going to listen to what the markets are telling you? They're telling you, get out. But the problem is this stuff too? It's based on treasuries, the government. What backs it? The full faith and credit, right? So as long as you trust them, you'll continue to loan money to the government. What happens when you don't trust them? Actually, you know what happens? I'll do it with this one because it's bent. This is what happens. It has absolutely zero value. No value. It really has no value right now, even officially. Only 3 cents. But you do what you want. I know what I'm doing. The Fed will have to stop its balance sheet runoff or the reverse repo facility entirely drained. At the same time, that money market fund assets rise to new all-time highs. So, you're running into the chicken coop and the foxes are holding the door open and they've got a whole band of foxes in there. I'm telling you, as a chicken, I'm running to the safety of gold. I'm not running into the chicken coop, but a lot of people are. Total climbed to 5.965 trillion. And the sad part is people think that these are safe. But there were a number of people in 2008 that learned that money markets are not so safe. So they changed the rules, making it harder for you to liquidate your money markets. That was the solution. And they drained a lot that was going to corporations. The government drained it into prime accounts that have government debt on there. But that's the public. We already know, I've done videos on this recently, where the long-term holders that don't really care about price fluctuation are getting out of the market, including the Federal Reserve. That's what we're talking about here today. And the public is getting in. Voila, that's what we're talking about here today as well. And you can see this goes back to 2020 with a big spike into interest rates. But government funds, which invest primarily in securities like treasury bills, repurchase agreements, and agency debt, saw assets rise to 4.878 trillion. So you think you're safe in government funds? You know, there is this bridge in Brooklyn that I'd love to sell you. Because you believe this, you're gonna believe that. But I'm going to tell you the truth because I actually don't really own a bridge in Brooklyn, although my father was born there in Canarsie. Okay, so the markets in general sees the Fed's exit from quantitative tightening nearing, which is why you see interest rates dropping down and therefore short-term bond values, market values going up. That's why you see the markets. Markets have been very volatile, but the markets have been going up. The problem is that all of those pieces of Wall Street intangible crap is all based on this. Well, this is my funny money, but basically based on dollars that are also losing value via inflation. I mean, you're experiencing inflation. Is that because those things that you're buying are worth that much more, or that the dollar is worth that much less? That's what it's about. And that's the only thing they have at their disposal, right? So now, hey, interest rates are up, 5.5%. The Fed has room to drop them down. So they broke the broken market that they created. Then they're going to go bail it out again? Well, it only works so many times. Volatility has erupted again. Gyrations in repo rates sent one benchmark to a record in the past week, while the market for short-term loans collateralized by treasuries fluctuated, which means went up and down, up and down, up and down because of that volatility. In fact, volatility in short-term funding markets can hinder central bankers' ability to manage monetary policy. Oh my goodness. Don't worry, we'll let them bring out the CBDCs, the central bank digital currencies, and what do they say? We can have our finger on that button 24/7. You are going to be so off balance with anything they're doing unless you have food, water, energy, security, barterability, wealth preservation, community, and shelter. You need to get those things locked in.
Lynette Zang concludes her discussion by emphasizing the broader implications of central bank policies, particularly the introduction of central bank digital currencies, CBDCs, and their impact on individual financial security. She argues that CBDCs will give central banks unprecedented control over the financial system, allowing them to monitor and influence economic activities continuously. This control poses significant risks to individual financial freedom and security, making the need for tangible, secure assets like gold even more critical. Zhang points out that CBDCs are essentially a tool for central banks to have a finger on the financial pulse of the economy 24/7. This constant oversight means that individuals will be vulnerable to any policy changes or decisions made by central banks. The introduction of CBDCs could lead to more intrusive financial policies, such as negative interest rates or automatic taxation, which could erode individual wealth and financial autonomy. In this context, Zhang stresses the importance of securing essential resources and building a resilient strategy to withstand potential economic upheavals. She outlines a comprehensive approach that includes ensuring access to food, water, energy, security, barterability, wealth preservation, community, and shelter. These elements form the foundation of a strategy designed to provide stability and security in an increasingly uncertain economic environment. A cornerstone of this strategy is the acquisition of physical gold. Zhang expects much higher spot gold prices in the near future, driven by the underlying instability in fiat currencies. She argues that a rising gold price is an indication of a failing currency, which central banks are keen to suppress to maintain public confidence in their monetary policies. However, the physical gold market continues to see new highs, reflecting strong demand and recognition of gold's intrinsic value as a wealth preservation tool. Zhang emphasizes the urgency of building positions in physical gold while it is still accessible. She encourages individuals to question whether they want to remain at the mercy of central banks, who can manipulate digital currencies at will. Owning gold, a financial asset entirely outside the system, offers complete freedom from counterparty risk and serves as a reliable store of value in times of financial instability. Moreover, Zhang highlights the potential volatility and interest rate spikes that could force the Federal Reserve to pivot from its current policies. She questions whether Wall Street or central banks wield more power in this context, suggesting that the interplay between these institutions will significantly influence future market dynamics. The underlying message is clear. Gold's breakout in the spot market, despite efforts to suppress it, reflects its enduring strength and importance. Zang also discusses the psychological impact of market volatility on investors. Many new investors who entered the gold market during its recent rise have been shaken out by the recent sell-off. These investors, having suffered losses, may be reluctant to re-enter the market, waiting for more significant dips that may never come. This behavior benefits long-term investors who remain committed to their positions and are better positioned to capitalize on future rallies. She advises investors to focus on the long-term fundamentals rather than short-term market movements. The current economic environment, characterized by high debt levels, ongoing monetary easing, and geopolitical tensions, creates a favorable backdrop for gold. These factors make precious metals an attractive investment for those looking to preserve wealth and hedge against economic uncertainty. Zang also highlights the importance of understanding the broader economic context and not being swayed by short-term market movements. She emphasizes that the real value of gold lies in its ability to preserve wealth over the long term, especially in an environment where fiat currencies are losing value due to inflation and monetary policy missteps. In addition to the financial aspects, Zang stresses the importance of community and local networks in times of economic instability. Having a supportive and resourceful community can provide additional security and stability, enabling individuals to better navigate financial crises. This communal support is essential, especially in scenarios where traditional financial systems may fail or become unreliable. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.